For a lot of people, investing feels scary, intimidating, and makes them feel overwhelmed. Well, I'm here to tell you that it's as easy as baking a pie. Let's get cooking. So when it comes to building an investment portfolio, the analogy that I use is that it's just like baking a pie. Because who doesn't like pie, right? So let's bake a pie. Let's build an investment portfolio. What you need to understand is that the crust of the pie, those are your bonds. Bonds are safe and stable. Bonds are debt. When we buy bonds, we're loaning money to governments and corporations, and they pay us interest on that debt. So when we own bonds, we're earning interest every single month that cash shows up in our portfolio. And what's great about bonds is that they don't move up and down too much, just a little bit. Bonds do move up and down with changes in interest rates. So when interest rates go up, the price of our bonds goes down. And when interest rates fall, the price of our bonds goes up. But interest rates are going to go up and down over time, and they're not nearly as volatile as stocks, because stocks are the filling. Why do we really eat pie? We want that filling. Why do we really invest? We love our stocks because stocks have a higher long-term expected return. That this is really where we're going to make the bulk of our returns over a decades-long period is going to be from our stocks, because stocks are shares in company. So when we buy a share in a company, we are sharing in that company's profits and losses. Now, hopefully it's profits. And when a company profits, they're going to pay us a dividend. Now, this usually comes every quarter, every 3 months. You'll get a nice little cash top up in your account ready to be reinvested. But the real way we earn returns through stocks is through the price going up. That over time, when companies are profitable, their share price goes up. And that's really the way we earn those long-term, higher expected returns. And what's beautiful about stocks and bonds is that they tend to move in opposite directions. They're what we call inversely correlated. This means that when stocks go up, right, when there's a boom in the stock market, then it's great. Stocks go up, but our bonds are going to stay stable. But because when stocks go up, sometimes interest rates, right, also go up. The economy's a little overheated. So interest rates go up, bonds are going to come down in value by a little bit. Not enough to offset. We're still doing very well in those boom times, right? But the opposite is true, is that when stocks crash, and not if stocks crash, but when they crash, because this is inevitable that stocks will crash at some point. Well, what's going to happen is that central banks are going to cut interest rates, which means that bonds are going to go up in value by a little bit. That they provide that sort of safety net or that buffer for our portfolio, that even when there's a crash, well, now there's part of our portfolio that is actually going up in value a little bit. And so this is why stocks and bonds go so well together, like pie filling and crust, and why we always want to have that nice mix of stocks and bonds, is so that over time, we can rebalance our portfolio. We can keep the mix of stocks and bonds at the right level. And this is like the biggest decision we make when we're baking a pie, is how thick of a crust do we want to have? What percentage of bonds do we want to have in our portfolio? Because someone with a longer term horizon, if you're younger, the stock market crashes, who cares? No big deal. Right? You've got a long-term horizon. You don't need this money for decades. You can wait for it to go back up. But for folks who are older, who are approaching retirement or maybe even in retirement, they don't have time. So they need a thicker crust. They need more bonds inside of their portfolio. And one of the biggest mistakes I see people make when it comes to investing is having too thin of a crust. Especially recently, markets have been doing really well. I'm seeing a lot of folks that are having almost 100% stocks in their portfolio. But that can get a little bit scary for when there is a crash. And so nobody wants a soggy bottom on their pie. So it's really, really important that we do have the right thickness of crust, that you do have at least some bonds in your portfolio so that we can rebalance during a crash. It's really critical that we have that mix right. Now, when it comes to the sustainability side of things, it's really important to understand what are the ingredients that we have inside of our pie. Because when we buy a standard non-sustainable portfolio, we're going to have all kinds of nasty things in there. It's going to have weapons in there. It's going to have fossil fuels in there. It's even going to have for-profit prisons in there, which in the US right now is something we want no part of. We don't want to profit from that. So instead, what we can do is buy an organic pie. There are investment portfolios that don't have those things inside of them. And you can buy the stocks and bonds separately. You can buy the filling and the crust separately, or they're even like frozen, pre-made organic pies that don't have any of those things. We're going to look at a specific example of that next time. For now, it's really important to understand that what we're trying to do is to build a doing less evil investment portfolio with this mix of stocks and bonds. That is our pie. And if you want to stop there, that's no problem. A lot of people like their pie plain and simple. That's no worries. But people who come to me often want a little bit more than that. They want to make it a little more sustainable. And so the way we do that is we can just throw some ice cream on top of that pie by investing in thematic funds. And these themes are usually green themes, things like renewable energy or clean technology, or they're funds linked to the UN Sustainable Development Goals. Now, these aren't as diversified as the Doing Less Evil Fund, so I don't want you to put all of your money into these things. They really are the ice cream on top of the pie. And again, you don't have to have the ice cream. And to be clear, a lot of those things are already in the pie. The pies that we're buying are so diversified that they have a little bit of renewable energy and clean tech and water in there already. But as sustainable investors, a lot of people come to me and they want more of those things. So no problem, not a big deal. We can just put a nice big scoop of ice cream on there, right? We can carve out part of your portfolio for these doing more good thematic funds. They're not as diversified and they might be more volatile. So that's why I don't want you to put all of your money in them. But they can absolutely be part of that mix. And then the cherry on top of the pie are the impact investments. These are the things that I love so much. If you've been following the channel, you've heard a lot about community bonds and renewable energy cooperatives and these really cool places where you can invest to be able to earn a financial return, but also have a positive impact. And as much as I love these impact investments, again, I really don't want you to put all of your money into them. They really are the cherry on top, especially if you're just getting started. I have no problem if you buy like one bond or carve out a small part of your portfolio, like 3% or 5% of your portfolio for these impact investments. They really are just the cherry on top. Now, as you get more comfortable with investing, we can certainly make that a bigger part. And especially as your pie gets bigger, that over time, if we look at the size of your pie and you say, hey, Tim, I've got more than enough money, that's when we can really carve out a bigger and bigger slice for these impact investments. But especially if we're just getting started, I really don't want you to go wild on them. It really is just the cherry on top of the pie. I want you to do it right? Especially if this thing resonates with you, to get those warm fuzzies. If you're worried about greenwashing, then this is a great way to ensure that you are having that positive impact with your portfolio. I just don't want you to put all of your money into these things, because really it is about that pie. It is about that traditional mix of stocks and bonds that are going to earn those market rates of return. That's really how we're going to earn our the financial returns that we need to be able to meet our retirement goals. And then from there, the impact investments are really just the cherry on top. So that's it. It's pretty straightforward. This isn't rocket science, right? You didn't need to be good at math. You might have to measure things out a little bit in terms of your ingredients. We are going to have to use some percentages when we talk about how thick of a crust you want and, how big of a dollop of ice cream to put on your pie. But it's really not that hard. My hope is that you'll go on my website and use my free tools where I have my lists of all the different ETFs that are available, as well as all the different impact investments. I've got model portfolios there that are basically like version recipes for pies that you can use to be able to decide what kind of investment portfolio you want, what are the sustainable ingredients that you want to use to bake your pie. And if you need some help, I invite you to join my Good Investing Classroom with tools, resources you can use right away, mini courses, and the chance to ask me anything, it's a place where investing starts to feel clear, doable, and even meaningful. And if you want to meet before the March 2nd RSP deadline, you need to get on the calendar right away. Schedule a free consultation at goodinvesting.com. If you've watched all the way through to the end, thank you so much. It means the absolute world to me. If you could like the video, comment, and subscribe, I would be so grateful. We'll see you next time.